Do I need 20% down payment to purchase? So in today's video, we're going to debunk that 20% down payment myth and make sure that you understand that you have options if you find yourself with the majority of folks who don't have a 20% down payment. And don't leave, because I've got an answer to a super commonly asked question, which is probably the reason why you're here watching this video in the first place. My name is Gavin Sessions with Loans Made Simple. If you're curious to learn about all things related to mortgage and home loans, subscribe to our channel. We post new content each week. If you're ready to get qualified for a home loan, or you're looking to get connected to a great real estate agent, our contact information is in the description below. All right, so let's jump into the 20% down payment myth and debunk it. So we get this question all the time. Folks think that they need to have a 20% down payment to buy a home, and it's rarely the case, honestly. So a 20% down payment is certainly beneficial and powerful for you, but it's not a requirement. And if I think back to my first home that we bought back in 2009, we certainly didn't have a 20% down payment. We had a 3.5% down payment, but it was a great decision for us then, and I would repeat that decision again, no brainer, all day long, over and over again. So what does a 20% down payment get for you? A couple of things. And the first is what everyone is really trying to avoid, which is PMI. And PMI stands for private mortgage insurance. And what that is an extra insurance policy that the lender requires you to have if you have less than a 20% down payment. It protects them in the event that you as the borrower default and fail to make your payments. Another super common benefit that we can't ignore is the fact that a larger down payment lets you have a smaller loan amount. And a smaller loan amount can lead to favorable loan terms for you, but also a smaller loan amount is going to give you a smaller monthly payment. One of the things we always like to do here is make things less ethereal. So here's a quick example of a $500,000 home purchase using a 30-year fixed rate mortgage, an interest rate of 7%. If you made a 20% down payment, that would save you roughly $500 per month compared to a 5% down payment. $500 is real money for most families, and that is a substantial savings that if you had the ability to make a 20% down payment would certainly help you achieve. So another benefit with a 20% down payment is you're going to start off right off the bat with a 20% equity position, which is super strong. Now, equity, you may not even know what that means, but equity is the difference between the home's value and what you currently owe on the property, right? So if we back up to our $500,000 example, if you bought the house for $500,000 and made a 5% down payment, your equity position would be 5%, which is $20,000. If you made a 20% down payment, that's $100,000 on that example, and you'd have a $100,000 equity position. That's super powerful because in the event you needed to sell your home quickly for whatever reason, regardless of the market conditions, you'd probably be able to get that home sold super fast. Whereas somebody who starts off with a minimum down payment of 3 to 5%, if push came to shove and for some reason they had to get out of that home quickly, there's a chance they may be selling when the housing market has potentially corrected, or maybe their home isn't worth quite as much as it was when they bought. And that would obviously just be a much less favorable position to be in. So we've debunked the 20% down payment myth, but there are some occasions where a 20% down payment would be required. And that's generally going to be when you're going to get a jumbo loan, which is where the loan amount is greater than the conventional loan limit. The way to offset that risk is with additional down payment. Or maybe you find yourself in the non-QM space, which is a portfolio product for a borrower that doesn't qualify for a traditional loan. So an example of that would be using bank statement income to qualify, or maybe potentially asset depletion or debt service coverage ratio. So if all of that just went right over your head, don't worry. It may not apply to you, but if it does, we would love to discuss that with you as well. So leave us a comment. We'll get back with you on that as soon as possible. One other area where you can expect to bring a substantially larger down payment, actually a 25% down payment, is if you're planning to buy an investment property that is between 2 and 4 units. So that is a duplex, triplex, or fourplex. The only way you can buy one of those that you don't plan to occupy one of the units would be with a substantial down payment, typically 25%. All right, so let's jump into options, right? Because if you find yourself in a situation where you don't have a 20% down payment, it is still a great idea for you to buy a home. So the first one that we want to highlight is an FHA loan. All right, so FHA loans stands for Federal Housing Administration. They're an awesome product for first-time home buyers, specifically because of the 3.5% down payment minimum. If you don't have 20%, maybe you can come up with 3.5% much easier, and I assure you that you can. This is actually the loan that my wife and I used to purchase our first home back in 2009. We had great credit, but we didn't have a large down payment, and this loan opened the door for us to be able to buy our first home. I often call the FHA loan a great get-in-the-door product, right? One of the benefits of FHA is low down payment, but also much easier to qualify. You can have a higher debt-to-income ratio. You can have lower credit scores. So it's a really great product to open the door for you. There is a couple bummers that we want to highlight here. We won't get exhaustive on this, but FHA does require both upfront and monthly mortgage insurance. It's called MIP, Mortgage Insurance Premium. The cool thing about the upfront mortgage insurance policy, it is financeable into your loan, so you don't have to bring that to closing, but your monthly mortgage insurance with FHA is required to be in place for the life of the loan, unless, of course, there's one example where you have a 10% down payment or more, and then your monthly mortgage insurance is only in place for 11 years. We've already mentioned conventional loans, but they're a great option as well, even if you don't have a 20% down payment. Now, conventional will allow you to have as little as a 3% down payment, which is great for first-time home buyers. But the one thing with conventional that's tricky is if you're going to have a 3% down payment, we often find that loan terms might be favorable for FHA. So if we're in that 3 to 3.5% down payment range, typically we see FHA being a little bit better in interest rate as well as monthly payment. So it's a better potentially get in the door program. For conventional, we'd love to see at least a 5% down payment. Now, of course, 3% is allowed, but we typically don't see conventional terms be favorable for you until you have at least a 5% down payment. So the cool thing about conventional is mortgage insurance is still required if you have 20% down, but it's not required for the life of the loan as it is with FHA. So hopefully that makes sense. All right, so another great loan product for somebody without a 20% down payment. And frankly, this loan product is so cool. It's called the VA loan. It actually allows for 0 down payment if you're an eligible veteran or if you're an active duty or a surviving spouse. So fantastic loan program. We have done a film specifically on the VA loan that we would love to point you to, and we'll get you a link to that here at the end for additional details there. But the VA loan, generally speaking, the coolest thing about it is no down payment requirement, which is fantastic. The other cool thing is no down payment required and also no monthly PMI. So no monthly mortgage insurance there. VA loans also allow for higher debt to income ratios, which make it easier to qualify. And interest rates with VA can often be some of the best of any loan program out there. So fantastic program. We would love to help you get qualified for a VA loan. Scroll down, find our contact information. We'd love to chat with you more about that. All right, so another great product, if you don't have a 20% down payment, is the USDA loan. It's a fantastic product through the United States Department of Agriculture. Similar to VA, you can actually get a USDA loan with 0 down payment. But eligibility is a big thing with USDA. So you have to be in a rural area. So basically any urban area in the United States is going to be off limits. But there's lots of markets where the rural area starts closer to the urban area than you might think. So it's worth looking into all addresses to see if a specific property might be eligible. The other trick with USDA is it does have very strict income limitations, meaning you can't make too much money to qualify for a USDA home loan. So both location and income are going to be strict requirements there. So some of the benefits obviously are 0 down payment, potentially lower interest rates, and like VA, less stringent credit score requirements. So just keep in mind though, the eligibility is tight, right? So we obviously love this product for the right location and the right person. But remember, you can't make too much income. It has to be in the right location. And the one thing we have not mentioned quite yet is one additional trick with the USDA is the debt to income ratio limits are really tight, tighter than actually any other government program. So if we were to rewind back, VA allows for higher debt to income ratio limits. Then I would say FHA also allows for higher, and it would rank below VA from that standpoint. And then of the third, if we were going to rank USDA, it would fall at the bottom as they have the tightest debt to income ratio requirements. So with USDA, you are going to have some upfront and monthly mortgage insurance. So keep that in mind, but that would be less than what you'd find with FHA. Just want to pause the video for a quick moment and invite you to connect with us. If you're ready to take the next step to get qualified and speak to a mortgage professional, a loan officer, or if you'd like to get connected to a great real estate agent, click the links below. So we've talked about ways to buy a home with less than a 20% down payment, but the programs we just highlighted, unless you're VA or USDA eligible, they're going to require at least a 3% down payment, right? So FHA requires 3.5%, conventional is going to require at least 3%, but recall that conventional probably makes the most sense if you've got at least a 5% down payment. So what if you find yourself with no money or very, very little money and you can't scrape together that 3 or 3.5% down payment? So your state and local municipality likely offers down payment assistance for both first-time home buyers and or low to moderate income. So down payment assistance is a great program for folks that would like to buy a home now, but just may not be able to scrape together the funds to meet that minimum down payment. So what you're typically going to find, and this is not scary, is either a grant or a traditional second mortgage. And both of those programs are going to help cover some or all of your down payment. One of the coolest things is that some of those grant programs, depending on the state where you're in, they may offer forgiveness so long as you've occupied the home for a minimum period of time. That's usually 5 to 7 years. And you have to have great standing of your payments, right? So in other words, you can't miss payments or be late on your payments. If we're talking about a traditional second mortgage, you're often going to have a regular monthly payment on that. typically for a shorter term, right? So usually your first mortgage is going to be for a 30-year term, usually, right? There's obviously 15-year and 20-year terms out there. That second mortgage to help with your down payment probably is going to have a shorter term than that. Maybe 10 years, maybe 15 years. It's going to depend upon the state that you're in. As we said before, this is not scary. These programs are awesome to help open doors for folks that may not have sufficient down payment. One other cool thing I want to mention is some states actually offer what they call a silent second lien. That's a silent second mortgage, where it doesn't require a payment at all and it doesn't accrue interest at all for the life of that loan. So what they would require is for you to stay in the home for a minimum period of time typically, and then they're going to require that that second lien be paid in full through the proceeds of selling that home in the future. If you'd like to know if your specific state where you live offers down payment assistance, scroll down, find our contact information, or reach out to us. We would love to get that question answered for you. All right, another alternative to down payment assistance is a family member gift. Now, family member gifts are awesome, but lenders are going to have very specific guidelines for those gift funds. It has to come from a family member first and foremost. You can't just say that your friend is a family member, right? It has to be from a specific family member, mom, dad, grandma, grandpa, uncle, aunt, brother, sister, etc. And that has to be structured truly as a gift, right? If it is structured as a loan, then that's going to count against your debt to income ratio, and that may prevent you from being able to qualify. All right, so we've talked about down payment assistance. We've talked about gifts. What about other forms of assets that you may have access to? Well, what if you get a tax refund? Yes, you can use that tax refund to help with your down payment. But what if you have a 401k or a retirement account? Can you use those funds to help with a down payment? The answer is yes. Now, I have to caveat here. I am not a financial advisor and I don't want to give you bad advice. We would love to chat with you about that specific question. We'd also love to get you connected to a great financial advisor if you find yourself without somebody in your corner helping you both build and protect your wealth. So reach out to us. We'd love to get you connected. All right, so we've talked about the 20% down payment myth. We've talked about down payment assistance. We've talked about loan programs that are available to you if you have less than a 20% down payment. So this really isn't even a question. Should you buy a house if you have less than a 20% down payment? The answer is absolutely yes. And let us give you an example to advocate for that. So let's put it this way. You maybe have that family member in your ear that's saying you have to wait to save up a 20% down payment before you could buy a house. Well, we've just showed you that that is not the case. Now let's show you some math to help you have a conversation with that family member to make sure that they believe that you're making a great choice. All right, let's jump into this example. To save for a 20% down payment could potentially take you years. And while you're saving, the housing market is simultaneously appreciating, likely on average at about 5% per year. So the cost of waiting is real, my friends. All right, so let's use a $400,000 home purchase example. If we jump into simple math, it's going to show us that the housing market appreciation average of 5% is likely going to outpace your savings, right? So most of us are not going to get greater than a 5% return on our savings, but even if you invested that in the market, an advisor might say they could get you 7% on average, which is great, right? But your savings growing at 7% is a much smaller basis than a $400,000 home growing at 5%, right? So 7% return on your savings, 5% return on your house. You might think that your savings is going to grow faster. I assure you it will not. The basis of that $400,000 home at 5% is going to outpace your ability to save. Now, don't hear what I'm not saying. I'm not saying don't save up as much down payment as you possibly can to purchase a home. I'm just saying if you have the opportunity to buy a house now and you're able to qualify, it makes sense to get your name on that piece of real estate and have it start appreciating for you on average at 5% per year. All right, so getting further into our example here, let's say that you're able to somehow save $10,000 per year. And like we said before, you've invested it with an advisor with a 7% rate of return. It's going to take you about 6.5 years to accumulate that 20% down payment, which in this example, back to our $400,000 purchase price, is $80,000. So $10,000 a year, 7% interest, 6.5 years to get that $80,000. Here's where the math is working against you. So if the housing market appreciates on average about 5% per year, that $400,000 home will actually cost you, or could actually cost you, about $550,000 6 years later. So yeah, you've saved $80,000, which is great, but that $400,000 home is now $550,000, and now you're still short of your 20% down payment. The target is moving on you. So congratulations again on saving that $80,000 from nothing. That's a huge accomplishment. Very, very good. I applaud you. But unfortunately, that home appreciated likely $150,000 during that time period, so there's still a $70,000 gap. All right, so again, congratulations on that $80,000 of savings, but instead of waiting 6.5 years, we would put our cards on the table, which are very obvious, and say, we think you should buy the house now. That's assuming that you can qualify and afford the monthly payment, right, with that larger loan amount. So I would suggest buy that house with a 5% down payment and leverage your current savings, a family member gift, or some down payment assistance to make it happen. If we wait 6.5 years, here's an example. Your home might be worth as much as $550,000 and you would have gained as much as $130,000 of equity. Another great carrot to dangle is, let's say you bought the house with an FHA loan, right? And you knew that was just your get in the door loan. Well, the cool thing is years down the road, when your equity position has grown, we could actually refi you out of FHA, get rid of your mortgage insurance, ideally save you on your interest rate, and reduce your monthly payment because your equity position has grown. How does that sound? So you might think I'm biased, and I am in the industry, so you would not be wrong there, but this is simple math is the reason I would advocate for buying a home sooner than later. But that being said, I want to clarify and just ensure that you understand when you use a smaller down payment to buy a house, you're going to have a larger loan amount, which means you will accrue more interest. It's not the least expensive route for sure, but it does get your name on a piece of property and get you into the appreciation game, which makes a tremendous difference for you and your family in the long run. Hopefully you now have a great understanding of your down payment options and that it's not necessary to wait for a 20% down payment. And actually, we would advocate that you don't. All right, so for your next video, I suggest you watch What is PMI, and it's going to help continue your education of the home buying process.